Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hi, everyone. We have a really nice show today. It's going to be kind of a summary of the comings and goings of July 2024. There's going to be some international content. We're going to talk about some updates in the countries of Australia, France, and the United Kingdom. And we'll also go into some international penalty litigation updates. And I'll kind of give some good context and background regarding what that really means. And then we'll talk about some domestic IRS issues related to identity theft, audit, exam, general news, scams, and then a favorite topic of mine, which is the whistleblower topic. We'll go into that a little bit because there's some updates there. But that's the basic kind of general format and context for today's show. Hopefully the folks that are looking for some international updates get some good nuggets there. And then those folks that may be looking for some domestic tax updates, you'll kind of get some good insight when we get to that IRS general news section of the podcast. But without further ado, let's start with Australia. Let's do the Australia tax update. So Australia's got a little bit of movement here. And for any US practitioners that are listening to the podcast, this is going to sound very similar to a set of laws that we have here in the United States called FBAR. FBAR basically is a withholding tax that normally applies in the context of when a non-US person, so what we call a non-resident alien, is selling US real property. So if I'm a non-US person and I'm living outside, say I'm living outside the United States and I own, maybe a condo in Florida, or, I own a house in New York or something, and I'm going to sell that property because I'm a non-US person, there's going to be a withholding tax that's going to apply at the point of sale, which doesn't really happen when you're just a normal US citizen or green card holder and you're selling property. There's no withholding tax. When you sell that, you just kind of deal with that on your tax return the following year. But for non-US people, there's a withholding tax, and that's under the FBAR regime. It's generally going to be 15% of the sales price if it's over $1 million. Yeah, and yes, you heard that correctly, sales price. Because again, the IRS doesn't know what your actual capital gain amount is. So it's based off of the sales price, or 10% if it's lower than $1 million. Now, there's some other things that you have to meet to kind of get that differential to drop from 15 to 10% when it comes to FBAR. And I have several webinars on our firm's YouTube channel that talks about the FBAR issues, because we do serve a lot of diplomats and international organization employees for which that also applies to. How that, though, applies to the Australia tax update. So now we'll get into Australia for a second here. So on July 23rd, there was a consultation paper, and this is normally how a lot of foreign countries deal with proposed legislation or new laws. You'll see that there's also consultation papers that are coming out of the UK tax update. But basically, the consultation paper proposed that there be an increase in the foreign resident capital gains withholding rate. That's what they call it, the FRCGW, as it's referred to in Australia. But it increases the withholding rate from 12.5% to 15%. And there is no threshold. So it doesn't matter. There previously was a threshold of 750,000 Australian, which call that maybe 500,000 US. So you'd have to basically have, a sales amount above that, my understanding, for the withholding tax to apply. So in this particular case, if you're a non-Australian tax resident and you own Australian real property, because that's what this applies to, and you sell that real property, under this proposed new law, there would be a withholding tax of 15% of the sales price. And then you would need to file a non-resident return in Australia if there's a differential that comes back to you. So a very interesting proposal. If it goes into effect, it will start on January 1st, 2025. And that's generally the update that I have for Australia. Okay, in the next section we're going to go to, there were proposed regulations by the IRS that were issued on July 11th. and they were issued based on what are called basket contract schemes. And that's a mouthful, but basically a basket contract scheme is some sort of financial contract or financial transaction contract that is in some way looking to convert what we call ordinary income to capital gain. In particular, you can have ordinary income or you can have short-term capital gains. Both are taxed as ordinary income, but you're trying to end up with a result where you go from those high rates of tax to a long-term capital gain, which is a much smaller amount of tax. Okay, so you're looking at a differential of say 37% at the high end when you're getting to ordinary income tax versus, capital gains tax rates can be 0, 15, or 20%. And so obviously, you want to end up with those lower rates if you possibly can. And the type of contract that's typically used is some form of derivative contract. And I'm not expecting our audience to really understand all the moving parts for this. But sometimes these contracts come in the form of what we call, at least offshore, come in the form of what we call life insurance or life insurance wrappers. And basically, it's something that looks like a life insurance policy, but really it's wrapped around some kind of option funded by a mutual fund or derivative funded by a mutual fund. And again, what we don't want to do is we don't want to have that income that gets deferred inappropriately. Deferral is a dirty word in the U.S. tax code. So if you don't have, the pass for deferral under the Internal Revenue Code and you're a U.S. person and you say you have an interest in one of these basket contract schemes, which again, offshore looks a lot like a life insurance wrapper. You definitely have to be very careful that you're properly reporting the income and the underlying assets. The proposed regulations do talk about the PFIC reporting, PFIC, which again, I'm not going to go too deep into what PFICs are, but they are very tax toxic assets for U.S. taxpayers. Most PFICs are going to be what we call foreign mutual funds. That's a great example of what a PFIC generally is, but you don't really get that great level of taxation, that capital gains tax rates, the qualified dividends, things like that. You get much more punitive tax treatment. And a lot of these life insurance wrappers have that. So it's kind of just pointing out the obvious, in my opinion. But there's a kicker here. The basket contracts, if you do have one of those, they're going to be what are called listed transactions. And listed transactions, you're falling into the same classification as the multi-QROPS schemes. You're falling into conservation easements. You're falling into things that are really looked at very negatively by the IRS. And there's a lot of disclosures that you have to do. There's the Form 8886, which if you don't do that correctly, carries a $100,000 penalty potentially. And then there's material advisor disclosures. Again, also similar, has really bad impact if you don't file those properly. There's a lot of penalties associated with those. There's a public hearing. So the IRS on proposed regulations always offers public hearings. There's a public hearing on the proposed regulations for the basket contract schemes. If anyone's interested in attending, you can go in person if you're going to be in the DC area, or you can listen to it over the phone. It's going to be on September 26th, and there will be instructions that the IRS will give to everyone for how you register for that if that's something that you want to do. Okay, so that's it for the basket contract schemes. We're now going to go into an update on FBAR litigation. And for those that aren't familiar with what an FBAR is, it's a weird acronym. It's called the Report of Foreign Bank Accounts. And it's funny because I have a lot of clients that will come to me and say, oh, the FBAR, that was put in by George W. Bush, that was put in by Barack Obama. Well, actually, the FBAR comes out of the Bank Secrecy Act, and that's Richard Nixon. That's how far back that filing goes. But basically, the way the FBAR works is that if you have foreign bank accounts, and what we're tracking, what they are tracking, not what we are tracking, but what the Treasury Department is tracking here, because this doesn't go to the IRS. The FBAR goes to a different department of the Treasury called FinCEN, Financial Crimes Enforcement Network, which if you ever saw Ben Affleck's movie, The Accountant, FinCEN would be the organization that's kind of the opposing force to Ben Affleck's character. They're trying to track him down. They're trying to arrest him. But FinCEN is going to be the one that tracks all this stuff. And basically what they're wanting from taxpayers is they want to see what's the maximum point at which your foreign bank account or bank accounts reached at any given point during the year. And you have to aggregate up all of those values. And if they aggregate to over $10,000 US, because again, a lot of this is going to be in foreign currency, so you do have to convert from foreign currency to USD, then you do have to, you file the FBAR and report that to FinCEN. And the failure to file, the non-willful failure to file for FBARs is the base is $10,000, but that's adjusted with inflation. So I think it's north of $16,000 civil penalty for failure to file the FBAR anytime from, I think, January of 2024 on. And that will, again, adjust with inflation for 2025. So it'll be 17,000 whatever in 2025. So very significant civil penalties. That's non-willful. If you're willful, meaning you really, you have an intent not to file, and there's a whole slew of case law that defines what's willful or not willful, then the penalty jumps to $100,000, and then adjusted with inflation, that's $166,000. And so, in July 12th, we have this case in the U.S. District for the Northern District of California, United States versus SAYDAM. That's SAYDAM. And basically, the court here it's really interesting because there's been a lot of cases, predecessor cases that turn on willfulness as it's related to Schedule B. And for those of you that don't know what Schedule B is, that's where you report your interest and dividend income. But if you look at the bottom of Schedule B, it's a really obscure part of it. It's part 3. There's a series of 3 questions, okay? 7A, 7B, and 8. And 7A and 7B relate to do you have a foreign bank account, yes or no? If you do have a foreign bank account, 7B says, do you have an FBAR filer requirement, yes or no? And a lot of those questions, or those 2 questions in particular, on most tax softwares are default to say no. So it's the default setting, unless if you're self-preparing or your tax preparer goes in and actually actively says yes, it's going to default to say no. The problem is that when you sign your tax return, you're signing it under penalty of perjury, that you've read the entire thing, you've read all the questions, you agree that all the answers and all the information, presented is that true, accurate, and complete, which a lot of people, I would say 99% of, people that use CPAs very rarely read every single part of their tax return, and, probably sign under penalty of perjury based off of faith that someone has done, everything correctly. Very rarely do I see someone that actually goes line item by line item and then comes back and asks questions. It's refreshing when actually a client does that, as long as they don't do that to the nth degree. I'm totally fine with that. And in fact, I desire that. But here we have, the court, there was a motion on the willful penalties where the IRS basically said, look, the Schedule B said no, the client signed under penalty of perjury. Schedule B said no to all the questions. The individual here had opened bank accounts with Zürcher Cantonal Bank in Switzerland, which is, I always tell folks, if you got Swiss bank accounts, the Internal Revenue Service, they know all about that because of all the time that the IRS spent in Switzerland between 2009 and say 2018 for the offshore voluntary disclosure program that was out there. So you got to be real careful about the disclosure of Swiss bank accounts. But this person actually opened Swiss bank accounts in 2009, which was the first year the IRS was really out there in Switzerland. So that's really weird. But I guess they kind of got wind that was probably not the best thing to do. And they moved all of their bank accounts to Turkish banks between 2012 and 2015. They filed their tax returns using H&R Block. In their defense, they said that the H&R Block software never asked them about foreign financial assets. And so there was the answer to the answer to the questions asked were no. IRS comes in and says, look, you filed Schedule B, you said no to the questions when in fact you did have an FBAR filing requirement. We're going to say that you're willful, and we're going to try to assess $100,000 civil penalties from 2013 to 2017, so about $500,000 of penalties. The IRS wanted summary judgment on that particular issue, and the judge denied it. The judge said, look, this is an item of interpretation that a jury could find in their favor. They could say that they're non-willful. And so we're going to leave the issue open. We don't think that there's enough here to really say that they are willful and close out the issue for good. And they cited a really interesting case, which was the Berga case, United States versus Berga. And they basically said that, there's no overarching legal consensus about signing a tax return and having what we call constructive notice of FBAR filing requirements that would meet the willfulness standard. So it's really interesting. This is kind of almost what we want the courts to do for taxpayers. It's been very, very draconian. Previously, there was I think a case called Hughes, where in 2 of the years there was a Schedule B and the client said no, and then 2 of the years there weren't. And so they threw the book at them for the 2 years that there was a Schedule B, but then they went easy on them for the 2 years that there wasn't. There really needs to be some form of conclusion, in my opinion, maybe even a Supreme Court case that comes down and says, this is the bright line test for, willful versus non-willful for FBARs. But we'll watch closely the Sadem case, and we'll see if, hopefully I'm saying Sadem correctly, but, we'll watch that closely and see if there's any movement on that and how that maybe, transpires as we move along on that one. But that's our conclusion for the FBAR reporting cases. We're going to move on next to what's called, and also in the same world as the FBAR, another form that's monitored by FinCEN. It's called the BOI form, or Beneficial Ownership Information Form. And so the next topic will be an update on that particular issue. Okay, so FinCEN BOI. This is a brand new filing requirement for a lot of people in the United States. It's basically for anyone that is an owner of an LLC or a substantial owner of an LLC or limited liability company. You have to file what's called a beneficial ownership information report, basically disclosing information about your LLC and information about yourself as the beneficial owner. Believe it or not, there is no such thing as there was prior to this, there was no such thing as a federal database of who owns limited liability companies or businesses inside the United States. I know a lot of people, when you watch NCIS or some of these TV shows or movies, it makes it seem like it's really easy to track down people or the owners. And, I remember watching, I think it was Fast and Furious, and they were talking about, we set up, layers of LLCs to block who, block owners or whatever it was. And, it's a very interesting topic, but basically what's happening here is that people this is a new requirement as of January 1st, 2024. So a lot of people have been filing and disclosing who they are. Now what's happening is the other shoe is dropping, which is, financial institutions, I would say state, local, and tribal law enforcement agencies are all wanting to take a peek at the information that's there, and they want to perhaps use that to either, from a financial institution, I'm wanting to verify if I'm giving money to a company or how that's working, that that's something I can still continue to do. Or for state, local, tribal law enforcement agencies, maybe there's some kind of civil or criminal matter that they're looking into, and they're trying to really collect data on that. So on July 22nd, FinCEN issued what's called a 30-day notice, basically indicating that they believe there's going to be about 16,000 different entities, again, financial institutions or law enforcement agencies, that will be seeking FinCEN information, FinCEN BOI information from what people are filing. They want some feedback on the best way to do that, the best way to make sure that, personal information doesn't fall into the wrong hands. I think that's a real big issue that a lot of people have, like who's getting my information, what will they have, how will they be using it, how will they safeguard that information. So comments are due on that particular process by August 22nd. So if you feel strongly or passionately about that issue, or you have clients that are into that, you may want to let them know so they can make their comments. Secondarily, on July 26th, BOI issued what we call a reference guide, which is super interesting. And basically, it's kind of, okay, if you're going to a financial institution and they're going to want you to provide some beneficial ownership information data, what does that look like, and how does that data then feed back into that financial institution's what we call customer due diligence, or CDD? Again, these are things that we really haven't had to do in the United States, but this is quite common in Europe and a lot of other countries where they really want to verify, know your client, have information, verify who the person is, make sure they're not on a blacklist or whatever it is. So the reference guide is kind of a first foray into that with financial institutions. And if you're living in that world where you're maybe setting up trusts or LLCs or things like that, and they're using loans or funding from financial institutions, it's definitely worth your time to maybe update yourself on that reference guide so that you can properly advise your clients. If you are an actual client and you're setting up companies and you're getting loans and all that stuff, you may also want to take a look at the reference guide to understand what obligations you need to meet to be able to satisfy the customer due diligence rules. I think those are going to get more stringent as time moves on, and people need to be aware of that. It's going to be a different world that we're living in when it comes to that 2025, 2026. Okay, getting back to international, and that's the end of the FinCEN stuff. Let's go to France. So there's a lot of cross-border movement right now. We'll talk about the United Kingdom a little bit later. There's some updates that recently came out about Italy. There's all sorts of movement on the various European countries, whether it's programs they're offering for visas for people coming inbound into their country, or potential major tax reform. But France had two really big updates in the month of July. The first was related to a case that came to the Court of Justice of the European Union about the right to protect personal data, which is a really big thing in Europe. I mean, they really want people's personal data protected. And when you're doing cross-border tax work for someone in the EU, I think a lot of tax practitioners miss the fact that you may have to comply with some of those rules and regulations when it comes to their personal data and how you're accessing or receiving the personal data, and that each country is different. I mean, because again, you have your EU countries, and then you have, say, a country like Switzerland, which has its own rules that you have to really comply with. So you got to be really, really careful about the protection of personal data. But in France, similar to the United States, they've had for quite some time a BOI, or beneficial ownership information, we call register. Theirs is more public, though. You can literally look that up you can go onto the register online and look up who owns certain companies and get certain information. Well, it may be a little too public and a little bit too much personal data being shared. And so the case that came from November of 2022 highlighted this issue and the EU right to protection of personal data. And so France has announced that they're going to be putting in new system filters for who gets to access the beneficial ownership information to really safeguard and protect data. So I think that's a big one for those people that are really into protecting personal data and not having that available. I think really what that's trying to guard against are going to be those fraudsters and the scam artists that are really trying to obtain people's information for identity theft or other nefarious purposes. Secondarily, and this is an ongoing issue, I'm going to have a podcast on this in the near future. We're going to talk about potential tax reform in France and the issues that could happen between the U.S. and France. But on July 28th, we've got the NFP, the Nouveau Front Populaire Prime Minister candidate Lucie Castex. Hopefully, I'm saying that correctly. Kind of speaking generally about, okay, if the NFP were to get in power, what exactly would they be pushing to do? They want major tax reform in France. And so the first big one, and again, this is really weird that someone would want to emulate the United States for this, but the first big proposal that she talked about was citizen-based taxation. So if you are a French person, a French citizen living in the United States, the way that would work, again, just like a US person living in France, you'd be subject to worldwide taxation. And that's a really interesting concept because they don't have that right now in France or any EU country. There's no citizen-based taxation that occurs there. So France would be the United States, France, and I believe the one country in Africa and I guess I've always heard North Korea has citizen-based taxation, but again, I don't think that really applies to too many North Korean citizens. But France would join that small group of countries that have that. So that's an interesting change if that happens. They would revisit the wealth tax. I think the wealth tax in France, and again, I'm super interested to get into a podcast and talk to an expert about this, but I believe the wealth tax only applies to very small segments of assets in France right now. It's very limited in its scope and nature, but an expansive wealth tax based on more assets. They want to expand asset taxation in general and then end business tax cuts. So that's basically a way, I think, to obtain more revenue for the country. That's basically what is kind of being talked about there. And so it's super interesting. We'll keep an eye on that front. Like I said, I'm super pumped about having a podcast to go over cross-border U.S.-France because I know that there are a lot of people out there that probably have more questions about what's going to happen there and how that's going to affect everybody. Okay, let's get into some domestic issues now. Let's talk about identity theft. So identity theft is a near and dear subject to my heart because at the beginning of my career, I worked on a lot of different cases for identity theft. I had a lot of different clients that dealt with the issue. Back then, it was the Form 14039, which is still around now. That's the ID theft affidavit. But then on top of that, there's basically a 3-part package where you also need to update your credit bureaus. So you reach out to all 3 credit bureaus and you file ID theft affidavits with them. And then you also file an ID theft affidavit with the Federal Trade Commission. Basically just trying to get on everyone's radar that you are directly a victim or could be a victim of identity theft. Well, we have every year the IRS takes cybersecurity super, super seriously. And so there's an Internal Revenue Bulletin 2024-193 issued on July 23rd related to the annual series the IRS has on cybersecurity. And they went over a couple things that I think are important for everyone to keep in mind. First off, it's important to know, and I can speak for this from actual knowledge, tax professionals, our firms are professionals personally, and firms are still big targets of identity thieves. I think if you're a tax professional, you have to be very careful about, how you respond to emails, how you respond to inquiries, how you send and remit information, especially when it has what we call personal identifiable information. You have to be very, very, very careful on each of those things that you do. That can slow down our response time, but I always tell my clients it's worth it for me to take that extra maybe day or so that I need, or whatever time is needed to verify, everything is done correctly, than to get into an issue where there could be an inadvertent disclosure, or for some reason, getting the information to the wrong person. So some things to note about red flags that the IRS recently identified for tax practitioners specifically. So for those tax practitioners, folks that are doing tax returns or maybe representing clients, a couple points to keep in mind. So first off, if your client receives a notice about an IRS online account that's created without their consent. So if your client says, hey, I don't have an IRS online account, but for some reason I got a request to create one, or I got like a verification request, that's a prime example of what could be an ID theft issue floating around. If you're a tax professional and you receive in the mail a transcript at your firm for a client, like say an account transcript or a tax return transcript, and you did not request it, perhaps you have an identity theft that has access to your tax pro account, your CAF number or whatnot. So be careful with that. Obviously, if there's notices that are incorrect or inconsistent with a tax return that's been prepared or filed, so for example, I prepare a tax return for a client and the client has $100,000 of adjusted gross income. Maybe they owe the IRS $1,000, and then I get a notice back saying that, the adjusted gross income is $400,000 and they owe the IRS $40,000. That's obviously a major inconsistency. There needs to be some thought process about why that is, what happened there, and really check that out and make sure it's legit versus perhaps issues that related to identity theft. If the client reaches out about calls or emails from the tax professional, so again, you have people that are pretending to be tax professionals saying, hey, and we've prepared your tax return, you need to send us your, email me your e-file form. Again, you want to trust but verify that that's actually something that the tax pro wants you to do. At our firm, we never ask people to email us anything. Everything needs to be uploaded through secure links. And I think a lot of tax professionals should kind of adopt that thinking, we need to really get away from emailing sensitive documents or emailing anything at all. Everything should go through secure links or uploads just to make sure that it's actually, legit. And that's the way that the information should be disclosed. And then obviously, if your client received a refund without filing a tax return, that's kind of a big, heads up, something's wrong there. If you see these issues happen, there's 3 things that you should think about for your client. So first off, the IRS now has what are called local IRS stakeholder liaisons for identity theft. You definitely want to notify them as soon as possible. So make sure you report to them. That could be also in the context. So the second thing could be in the context of completing the ID theft affidavit form with the IRS, which I talked about earlier. That's the form 14039. I'll make sure to link that into the show notes, and also put a link for the IRS stakeholder liaison, how to find those people. And then lastly, your client may want to consider getting an identity protection PIN, IPP, which is something that goes on page 2 at the bottom of the tax return. And if you get that, they issue those change every single year. So you're gonna need those before you can electronically file your tax return, or else you're going to have an issue with processing. So just keep that in mind. The last thing for identity theft that I think is a little troublesome is that the average processing time for an identity theft case is 675 days. That's a really, really, really long time. I mean, that's close to 2 years, and in many cases, it takes a lot longer than that. I think that's a function more so of IRS staffing and the allocation of resources to identity theft cases. They're not the easiest to work. Should those be worked by IRS civil? Should those be worked by IRS criminal? It's hard to really parse that out and make sure that the right people are working on the right things there. I think that there needs to be more studies that are allocated to identity theft and how to resolve these issues in a more timely fashion. But just keep that in mind, that it may take a very long time before the case is worked and things are properly set up there. Okay, next topic are IRS scams. So I'm going to stay on the identity theft, but I'm going to talk more about scams that are out there right now. So the first scam is called a new client scheme. And if you're a tax professional, you've probably seen these emails. I know I have. And that I always raise an eyebrow when I see it. But basically, it's a fraudster pretending to be a real taxpayer that is seeking the help of a tax professional. They've probably got some kind of malicious attachment or a link inside their email that they want you to click on. But they may be just trying to bait you to try to get a relationship with you. And then in some way, shape, or form, eventually down the line also. So it's kind of, there could be a longer term play there where they're trying to get you to click on an attachment or a link. But be very careful. Again, trust but verify when a new client just randomly reaches out to you. I like the fact that at the Wolf Group, a lot of our clients get referred to us through other professionals. So they're already vetted. I've already got that part down. But if you're someone that works off of, say, doing a lot of, online keywords or AdWords, or you're bringing in people from the internet, just again, be careful that scheme could hit you pretty hard. Just like taxpayer social security numbers or taxpayer identification numbers, or ITINs, what they're called. The second scam to be careful with is that fraudsters are now looking for the reverse of that, which are going to be tax professionals. And we have our own set of identification numbers when we're filing a tax return. There's what's called a PTIN, so that's our preparer identification number. We have a CAF number, that's how we, the IRS identifies who we are. And there's an EFIN number for filing tax returns for our firm. And if fraudsters do get this information, they can use that to prepare and file fraudulent tax returns. I always tell, the tax professionals that work in our firm or any tax professionals that I talk to, hey, go in and check to see how many tax returns are filed under your PTIN number. If it's some crazy number, then maybe, that's really, let's just say your tax firm does 1,000 tax returns a year, and maybe you only sign 100 of them, and you've been doing that for 10 years. If you have 50,000 tax returns that have been filed under your PTIN, then possibly someone's got that number and probably using it incorrectly. So be very careful with that. The next scam is artificial intelligence. Our good friend AI is being used to create fake IRS letters. So you could get an IRS letter that looks a lot like a real IRS letter, but it's fake. So again, anytime you get an IRS letter, trust but verify, contact the IRS, make sure that's actually legit. Do your due diligence before reacting to it, or have a tax professional do the due diligence for you. And then the last two scams are really social media scams. There's a social media scam called the Zero Tax Program, and that's basically people saying, look, I've got this method or this technique. You owe a bunch of money to the IRS, maybe back taxes or something related to that. I have a way to get all of that wiped out and drop down to zero, or get that all forgiven. And yes, there are things called offers in compromise, which may forgive large amounts of debt for small amounts of money. But again, I always tell people, be very careful about pie in the sky promises. Those things probably, if it sounds too good to be true, it probably is. So be very careful about what we call zero tax programs. And then there's a significant scam going around, I believe TikTok, our good friend TikTok, once again, into the social media scams, where it's basically saying that there's a potential for people that are self-employed. So a lot of influencers, gig economy people, where you can get what's called a credit for your self-employment tax by using Form 7202, which is not true at all. There's no such thing as a self-employment tax credit. The IRS has taken painstaking steps to kind of alert people that that's not a real thing. I'll put some links to the show notes on the social media scams. But basically, again, be careful about listening to people's tax advice on TikTok, Instagram, X, Facebook. I mean, just be really, excuse me, really, really careful on those things, because a lot of times it's wrong or doesn't give all the information. Okay, next big topic, IRS audit and examination. So as I predicted, once the IRS got a lot of the money from the Inflation Reduction Act and did a lot of their hiring, they've really tried to come out swinging to obtain revenue, because they know they have to kind of justify the revenue expenditures. And so on July 11th, there was an announcement based off of the high individual income audits, which have been going like gangbusters since last September. And the IRS basically said, we know of about 1,600, individuals that have not filed tax returns or not filed them correctly, because we have the wage and income documents. And yes, there are people that have W-2 statements with over $1 million, or maybe even way more than that have not filed tax returns, and nothing has happened to them for quite some time. And so basically, this is super low-hanging fruit from the IRS. They just have to have people that kind of shake the tree, and then what'll happen, or these individuals will file, revenue will be collected. Well, the IRS is touting we've got over $1 billion. We've looked at the 1,200 out of 1,600 individuals, and we now hit the $1 billion of collected revenue, which again, great for them, fantastic. But the one thing they didn't mention here, and several practitioners have highlighted this, was that as part of this effort of low-hanging fruit, there was supposed to be these tie-ins where these high-income individuals would also have interests in partnerships, S corps, foundations, trusts, foreign financial assets, and then simultaneously, in addition to the $1 billion collected, there'd be these additional audits, these audits that would creep in scope, where there'd be all these other things pulled in and all these other things that are happening, and not much has come out of that. My understanding is that there hasn't been a lot of that coming through. And in my head, I'm kind of like, well, yeah, because they probably have set things up correctly and done things. I mean, yeah, certainly there could be issues with, certain things that they may not have great advice on, say foreign financial assets, but probably highly unlikely that they have other areas of delinquency where they're really off. I think the non-filing is one issue, but are they also doing things incorrectly outside of that? I think that's a little bit of a stretch. So interesting to see how much more they go down the line with the last 400 people out of the 1,600, and what kind of comes out of that. The second issue is that the IRS has really a huge push right now on corporate jet usage. And so what's been happening, or what supposedly has been happening, is that you have these companies that have private jets, and then you have individual employees, or maybe even owners of the company, that are using the private jets, not for company reasons, or maybe they're claiming they're for company reasons, but they're actually for personal reasons. And if they truly are for personal reasons, then what should happen is that the individual employee or the owner employee would be issued a W-2 or a 1099 for the cost of the flight. And that's really based off of what we call a standard fare, industry fare level, which is in regulation Treasury Reg 1.61-21G5. But what's really funny is that the calculation for what that amount would be is significant. There's significant disparities. The IRS probably wants to go super high on what those amounts are. I think other people may come in somewhat at a more reasonable standard of what the cost would be for using the company jet on that. But I think that's an area that is ripe for not only audit by the IRS, but contesting how they apply that standard during the audit. I think you have to kind of hold the IRS accountable not to go crazy and include too much income, or income above and beyond the standard. And then separately, for the business that has the company jet, there's also the disallowance of the expenses, which I think is pretty straightforward about how you would allocate the expenses for that private flight. You would just basically remove those as a disallowed expense deduction to the provider on their business tax return. Okay, IRS general news. We're going to move on to IRS general news. That was it for audit and examination. A couple things to keep in mind. So I spoke earlier about individual online accounts. I want to make sure everyone understands that just like a doctor would recommend that you go get an annual checkup, the IRS individual online account, similarly, I know it's scary. You may get in there and you're under audit or exam or have an issue. But I would tell anyone, at least check it once a year, maybe even check it once a quarter if you're really brave. But there's some really cool things you can do with the IRS online account if you're an individual. You can get transcripts, like your account transcript that shows kind of what's going on for each tax year. You can check your wage and income transcripts to make sure someone doesn't have your social security number and racking up a bunch of, fraudulent work jobs against you. You can request an ID protection pin, which we talked about earlier. You can check on the status if you're under audit or examination. There may be ways to check on the status. You may be able to upload documents, which we'll talk about here in a minute. If you owe the IRS money, you can calculate what a payoff would be. So let's just say I owe the IRS money, and maybe I want to pay them off as of the end of this month. Then I can put in that date and I can get an exact number and make that payoff. I can do an installment agreement. So let's say I don't have enough money to pay my taxes and I want to set up a monthly installment agreement. I can do that through my IRS online account. If there's a refund, I can also check that through my IRS online account. Separately, if you're a business owner, you have a C Corp, S Corp, or a partnership, you can check your business online account as well. And so there's a separate account that you can set up just for that. I would advise a lot of business owners to, maybe have, if you're a small business, maybe you do it yourself, set that up for your business. If you're a bigger business, maybe you want to have your COO, kind of set that up and have that person required to check that on a regular basis. Speaking of that, if you're filing, payroll forms, the 940, 941, 943, 945 forms, the IRS now allows those to be the amended returns for those. If you have an issue with those and you want to amend them, those can now be filed electronically. So that's some new news there. And then the last two pieces of new news, I said earlier that you can respond to notices through your IRS online account electronically. Well, the IRS touted that they just received, this has been around since 2021, so it's not really an old thing. It's kind of still a new thing that you can respond to the IRS online. But the IRS announced that they accept their 1 millionth response just recently, which is really fantastic. I think that will help move things faster through the cycle time when it comes to receiving a notice and figuring out how to cure the notice. So if you're responding to IRS notices, again, I would urge you to go back and do it through your online account. And then lastly, the last bit of IRS news that I can share with everyone is on July 25th, the agency that governs the IRS or really kind of make sure, take steps to make sure the IRS is doing what they need to be doing. It's called TIGTA. It's the Treasury Inspector General. They published a report that a lot of contractors that the IRS hires are prohibited from using TikTok on their devices, and they're still not doing that. They're still using TikTok. I personally don't use TikTok, so I don't really know what you would do why you would be using TikTok. I assume it's something similar to, say, Instagram or Facebook. But again, a lot of contractors are not complying with that rule that they can't use TikTok. And so that still continues to be an issue with the IRS and contractors. So if you're a contractor with the IRS, stop using TikTok, please. Okay, the next topic for domestic is going to be required minimum distributions from individual retirement accounts, or IRAs. And so basically on July 19th, there were two things that came out related to required minimum distributions. And these normally occur when you hit a certain age. I believe it's maybe 72 and a half or 73 years old. You're required to start taking distributions from your retirement plans in the US. And there's been proposed regulations on RMDs, or required minimum distributions, since 2022. Those regulations went final on July 19th, and it updated, regulations related to a slew of Internal Revenue codes, 401, 402, 403. Those are going to be your basic governing codes for individual retirement accounts. And the final regulations apply to distributions beginning on or after January 1st, 2025. So if you're dealing with retirees, or your wealth manager dealing with retirees, you may want to kind of read through those and understand those. There's also, on the same day, there were proposed regulations put out for required minimum distributions that came under Secure Act 2.0. So probably 2 years from now, we'll have final regulations for those proposed regulations. But again, another area that you may want to update yourself on. Okay, moving on. So we have Ron Wyden, who is the Finance Committee Chair for the Senate out of Oregon. And Ron is very concerned about what we call, or what they're referring to as, the largest tax evasion scheme in history, and that's related to an individual called Douglas Edelman. But what's concerning about the Douglas Edelman tax evasion scheme is that this individual had 30 foreign bank accounts, or that's what they're charging. That they're charging him with 30 tax and foreign bank account issues that occurred in May of 2024. but a lot of those accounts were hidden in Credit Suisse in Switzerland. UBS, who recently purchased Credit Suisse in March 2023, is now under fire for, hey, it looks like Credit Suisse never disclosed the Edelman accounts when they settled with the Department of the Treasury, on their settlement agreement. So a lot of Swiss banks were under scrutiny by the Department of Treasury, Department of Justice, for hiding U.S. bank accounts for U.S. account holders. They had to disclose all those account holders to be able to settle with the Department of Justice. In this case, Edelman was never disclosed, even though they knew he had the money in Credit Suisse. You also have Dan Horsky, which was never disclosed. I think it was $200 million worth of accounts that were never disclosed. There was a dual citizen Latin American family that had 100 million of accounts that were never disclosed. And then simultaneously, we also have a whistleblower and we'll talk about whistleblowers here in a second, that are suing Credit Suisse under the False Claims Act because they're saying that Credit Suisse never disclosed any of these people, and there's supposedly a whole lot more. But they did so in an effort to reduce the overall penalty they ended up with from the Department of Justice. So, I've been dealing with offshore voluntary disclosure, for a very, very long time, over a decade now. And I keep thinking this issue is going to go away, especially when it relates to Switzerland or Swiss bank accounts. And here we are in 2024, the July 2024 letter to UBS from Ron Wyden, and we still continue to see issues and have issues. And it's a little disheartening to know that the largest tax evasion scheme in U.S. history could be on our doorstep and could come to light. More could come to light here in 2024, 2025. Speaking of whistleblowers, on July 30th was National Whistleblower Appreciation Day. The IRS awarded their first whistleblower in 2007, and the IRS has paid out over $1.2 billion in awards to whistleblowers through June of 2024, all while collecting about $7 billion of revenue through whistleblowers information. If you are a whistleblower and you want to submit an application for an award, the form that you fill out is the form 211, as opposed to the form 411 or 911. But it's the form 211, and they're supposedly in works to have that to be able to electronically file by 2025. So there you go for whistleblowers. Okay, moving on. We're going to get into some technical aspects here, and then I'm going to close out with some updates on the United Kingdom. So first technical aspect are going to be related to Internal Revenue Codes 6751A and B. And these are related to international penalties. So if you're a taxpayer and you've got a foreign trust or a foreign corporation or some kind of foreign business or foreign entity, you can get into real serious problems with the IRS by not filing certain international informational reports. And when that occurs, when the IRS, says, hey, you didn't file your report or you didn't do it correctly, the first thing they're supposed to do under 6751A, that's Internal Revenue Code 6751A, is they're supposed to say, here's how we computed your penalty. Okay, this is the years that you didn't file. This is the amount of the penalty. This is how we're assessing it against you. The IRS is notorious, though, for not really doing that. And I think a colleague, Dan Price, said it the best. He's a tax practitioner, former head of the IRS Streamline Unit. But he said, you don't show the math, you don't get credit for the result. Back in math class, if the teacher said, show your work, what happens if you just put the result? You get an F. Well, same thing here with the IRS. Like if you don't compute the penalty and give that to the taxpayer, you don't give them that notice, then really they shouldn't be allowed to collect the penalty. So we have the case of Groves versus Commissioner, where that's currently being disputed right now. On 6751B, so once you've computed the penalty and you've given that to the taxpayer, or you're going to give it to the taxpayer, what has to happen is that penalty then has to be approved in writing by a supervisor or manager at the IRS. That's what 6751B says. And in the DeSoto Holdings case versus Commissioner, so DeSoto Holdings versus LLC versus Commissioner, DeSoto received the penalty for a conservation easement. Basically, again, conservation easements, we talked about this earlier, are listed transactions, so they're a big no-no. But DeSoto argued that the penalty was never properly approved by a supervisor, even though, the revenue agent made the initial penalty determination, he got a lot of advice, or he or she got a lot of advice on making that determination, and then it was approved by a second supervising agent. There was a lot of things brought up in this case that were super interesting. One was that the lead sheet where you're supposed to sign as a manager was not created by the revenue agent. Is that required to be created by the revenue agent? The court said it didn't have to be. Someone else could do that, and then you could, the revenue agent could sign it, the supervisor could sign it. So really interesting case about 6751B. But here, in that case, the court held that everything was done properly under 6751B. Continuing along the lines of 6751B, there was a FOIA request made by Tax Notes that kind of wants to examine how supervisors are signing off on the lead sheet, which is typically lead sheet 300. And so basically, they're looking to get information from what's called CIS, or corresponding imaging system. That's where everything is kind of uploaded and held with the IRS related to sign off on penalties. And what was really interesting with this FOIA request was, okay, if you have the CIS that shows the name of the supervisor and the date the penalty is approved, and maybe a note or an email saying, penalty is approved, is that the equivalent of signature in writing, or do you actually need a copy of the lead sheet 300 signed physically by the supervisor? Which one is going to be can there be kind of almost this substitute process that occurs? This is still an open-ended issue, and more to come out of that one on 6751B. I think we're going to have more litigation that comes out of those two Internal Revenue codes. Moving on to international informational penalties, we've got two court cases in July that I want to talk briefly about. The first case is called, and again, I'm really bad with names, so excuse me if I'm butchering the name, but it's the Mukhi case, or M-U-K-H-I. And in this particular case, it's a super interesting case. But this one was this one came out on July 11th, where the IRS is basically asking the tax court to reconsider a decision in the original case. And what has happened here is that the tax court agreed that the IRS had, that the taxpayer had about $11 million in international informational reporting penalties, meaning that the client or the taxpayer hadn't reported international informational forms correctly, one of which was the form 5471 for controlled foreign corporation reporting. But the court went on to say that because of what's called a separate case called the Farhi case, that the IRS didn't have the ability to assess the penalties for the form 5471, and really that had to go through the Department of Justice, and there was a very convoluted way to do that. Well, the Farhi case has now been reversed in the DC Circuit, and so the IRS is saying, hey, let's reconsider, does the IRS have the ability to assess the penalties for the form 5471? And this one is super interesting because if the court reconsiders the ruling against Mukhi, then the taxpayer can appeal to the Eighth Circuit, which the Eighth Circuit may agree and say, hey, we feel like, the IRS does not have the ability to assess the penalties. We actually disagree with the DC Circuit Court on the Farhi appeal. And then you've got a circuit split, which will create havoc for the IRS. So a little bit of a tense issue here. We'll watch this case closely to see how it plays out, because the assessment of the penalties on the form 5471 is a pretty significant issue. Okay, the last international informational penalty case that I want to talk about today is the Geiger case, Gunter Grant Geiger versus United States. This is a super interesting one because here we have an individual that entered the offshore voluntary disclosure program, beneficiary of a foreign trust, trying to resolve that through OVDP. The individual passed away, and the son, who becomes the personal representative, says, look, I'm not going to sign off on the offshore voluntary disclosure. And so the deceased individual, the estate of the person, was removed from offshore voluntary disclosure for not signing the closing agreement in January 2023. Then the personal representative, the son, starts transferring assets of the estate without informing the IRS. The IRS gets wind of this and immediately sues for what's called jeopardy assessment on the estate, meaning, hey, we think this guy's going to get rid of all the assets before the IRS can get their slice. And the U.S. District Court for the Southern District of Florida agrees. And so a $15 million jeopardy assessment was granted on the estate to basically freeze everything and make sure the IRS at least got, their portion of the estate for what the deceased individual owes in potential penalties, tax, and interest. It'd be super interesting to see what happens now that the summary judgment has been granted on the jeopardy assessment on the estate, and see what happens and plays out next in this particular case. Also, super interesting factual case for those that want to read more about offshore voluntary disclosure and kind of the process that the taxpayer took through that. Okay, we're almost at the end here. I thank you for bearing with me through this July 2024 tax update. We have more coming out of the United Kingdom. I've got a very special podcast episode with Andrea Solana coming out very soon, where Andrea will be going through, she's a wealth advisor out in the United Kingdom. She'll be going through kind of some of the stuff I'm just about to talk about now. But basically, we have a Labour Party that has won the election in the UK. They won it on July 4th, 2024. It's the first time in 14 years that the Labour Party has been in charge of the government out there. And we have this new Chancellor of the Exchequer, Rachel Reeves, that has come out and said, hey, look, we've got a couple of things that are happening here. First off, we're going to put out our new budget. That's going to be on October 30th, so the day before Halloween. You're going to get some more insight into all the potential proposed changes. Simultaneously, on July 29th, they issued a policy paper called Fixing the Foundations, Public Spending Audit 2024-2025. And just for background here for you U.S. folks, why it says 2024-2025 is because the United Kingdom operates off of a fiscal year. They don't, unlike the U.S., which we operate on a calendar year, they operate on an April 6th to April 5th fiscal year. That's why it's 24 to 25. So if you want to learn more about what's happening in the UK, I would tell you to read that policy paper. And it talks about, things that they want to change. And then, Rachel Reeves also said publicly, look, two things to be clear on. We're not going to increase, what we're charging people for national insurance. We're not going to increase what we're, the VAT amounts, basically the UK version of sales tax. So those things are kind of off the table. But what also happened is that there's a bunch of other policy papers similar to Australia that came out related to Pillar 2, which I'm not going to go into. But there's talk of also a reformation of taxation on carried interest, the abolition of the non-dom tax regime, which Andrea Solana talks a lot about in our podcast with her, and then other small things like energy profits levy, VAT on private school fees, and the abolition of furnished holiday lettings regime. So a lot of movement in the UK, a lot of potential changes there. Looks like we'll get our first big kind of foray into that on October 30th. More to definitely come on cross-border US-UK issues and how, these changes in the UK may affect US people that are actually in the United Kingdom or thinking about going to the United Kingdom. We'll go through all of that as things progress. Thank you all for joining me here today. Hopefully you've walked away with a couple things that you can use in your life to help you with your tax situation, or perhaps if you're a practitioner, can help your clients. Like I said, a lot of this stuff will be linked in the show notes. So if you're looking for something that I've cited during the podcast, it should be there.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.